It's been a couple months since the last podcast, and I'm Truby, co-founder of FVEr Invest. FVEr again is FVEr. It stands for Fair Value Estimator, and we use 20 years of historical weekly pricing data to provide long-term fair value estimates for different parts of the market. We cover 18 broad market ETFs, all the S&P 500 sectors. We cover the semiconductor sector, SOX from iShares. We cover a few dividend ETFs. We use a proprietary algorithm, which is based on exponential regression. And we filter thousands of different trajectories to try to calculate our best guess for where we think the market is fairly valued at a particular point in time. The algorithm does extremely well across all of the ETFs that we cover. We've done extensive back testing. I have a math PhD, so I've been around numbers for a while. I believe in it because the numbers and the stats tell me it works. That's the reason why I believe in it. Not because I like it, because I made it, but because it actually works, and it historically works. And all of our back-tested strategies, which we'll be launching, work, and they're incredibly effective. It gives you a data-driven tool to optimize allocation to different market classes, and it's extremely effective. Both George is my co-podcast host, who I forgot to intro earlier before I got on a tangent here. Both George and I use it personally to make investment decisions, and it doesn't lead us wrong. It gives us good advice as long as we're patient and we have a 12 to 18 month horizon. George, you want to do a quick intro?
I help develop the main strategy, or help, in its infancy, develop the main strategy that at some point we will release, hopefully by the end of this year or early next year in some capacity.
You want to just go over that strategy really quickly for viewers, just to give a sneak peek?
Yeah,
what are the main components? What's the main?
The main idea, early in the infancy when we were working on this project together, we tried to create something that would essentially get you in and out of the market at specific points in time. And we found very quickly that it is almost always, if you are in the growth phase of your life, if you're a younger investor, it's always better to have exposure to the market. It doesn't really work trying to do a buy and sell strategy. What we did find is that when times that the market is extremely undervalued, you can incorporate leverage and increase your returns significantly when the market is underperforming. So our strategy is very basically, whenever our model indicates that the market is undervalued, we move into a leveraged ETF. And this is proven to perform very well, and actually is way less risky than being in that same leveraged ETF essentially forever. It's less risky than the leveraged ETF in and of itself, and it outperforms as good or better in some cases than the leveraged ETF. That's, hopefully I explained the strategy well.
That's great. So not only are you reducing risk, which is beta, in investing they call that beta. So if you're in a leveraged 2x ETF for the S&P 500, your beta is going to be around 2. You're taking like 2 times more risk than if you were just in the regular S&P 500. So if you outperform the S&P 500, it's not that crazy because you've just taken more risk. However, during times of extreme volatility, you can really get hurt being in the leveraged ETF the whole time. So basically, our strategy will sniff out particular points in time when we think it's optimal to move into the leverage ETF. We don't go into it during periods of high volatility. We have a certain window of time when it's undervalued where our strategy will allocate into a leverage ETF. And we can reduce that beta down significantly, lower than 1.5 or 1.3, I can't remember the exact numbers, but significant reduction in beta with an outperformance of the 2x leverage ETF, which basically gives us alpha. That's the special sauce, is the alpha right of our strategy. We haven't released these strategies yet because we're still fine-tuning them, but that's basically the idea of how you can use the FVE. We call it the FVE, or fair value estimator, to actually get outperformance. Is you can use leverage at the right times, namely when the market's pretty undervalued, allocate into it, and then pull out when the market then rallies and go back into a regular. And this really was George's idea. So he came up with this whole idea, and then I've helped him from a technical standpoint to try to fine tune it and optimize it, you know, statistically and mathematically. So George is really the architect of the broad idea of how you can use our website to do better.
Thank you. Thank you. That feels like a compliment. I mean, Truby does all the math. He's the math guy. He's done all the formulas. I mean, I had the idea based off of his initial research. So, I want to go back to what you said after which was, this is something that we both personally use, and it's something that we believe in, and it's something that we have seen works. Specifically, you know, in late 2022, we hadn't launched late 2022, early 2023, we hadn't launched the website yet. We didn't have, you know, our FVE or our 5-star rating, but we had the numbers. We had the numbers in a spreadsheet that showed what things should be valued at. At that time, we saw, you know, that SPY and QQQ were undervalued. And last week, or 2 weeks ago, 3 weeks ago, I think, and I want you to get into this, the Russell 2000 was a 5-star buy rating, or was it a 4-star buy rating?
I believe it's been dipping into 5-star, 4-star for a while. And just to remind or educate viewers, if you go to our website, we do a star rating for all the ETFs we cover. If you're at a 5-star, our algorithm is saying that we think that particular ETF is extremely undervalued. And if you're at a 1-star, we think that particular ETF is extremely overvalued. And obviously, you're a 3-star, you're sort of neutrally valued. And the star system is really important because it takes into account the long-term volatility of the particular index. So, you know, if you're 10% under the FVE, but you have a huge amount of volatility, you might still be in the 3-star or 4-star range. But if you're 10% undervalued and you have very low volatility, like you're in a really defensive ETF like S&P value or dividend, then you might be in 5-star. So you really want to look at the star rating and not so much the actual number that you're seeing for undervalued, overvalued, because the star rating takes into account the long-term volatility or spread of that data set. So yeah, the Russell 2000 has been flirting between 5 and 4-star for the better part of a year. The FVE, our FVE model for the Russell 2000 and the small cap 600, has been saying undervalued, 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 extremely undervalued, undervalued for, you know, a year, 9 to 12 months or longer. I think I made the first call that small caps were looking really undervalued in January of 2023, actually, so almost a year and a half ago. So our model cannot tell you exactly when the trigger or catalyst will happen, when the particular move is going to happen, like tomorrow or next week, but it will tell you that it's coming, you know, within the next 6, 12, 18 months. It's taken a while for small caps to rally, but they have rallied hugely. And if you had looked at our model last October, on October 27th, 2023, small caps were over 25% under their FVE. They were ridiculously cheap back in late October 2023. I mean, our model was saying this was hugely undervalued, to the point where, like, I think I remember maybe talking to George about, like, what is this telling us about the market? Maybe it's actually sniffing out something really bad. But the bull market continued, and small caps have rallied since that point 38%. They're almost up over 40%. flying pretty much under the radar of Nvidia and all the other growth stocks. The S&P is now up 37% from that time. So the Russell 2000, after their monumental rally in the last week, is now beating the S&P 500. So I want to stop there and let George interject. I have other just unbelievable statistics about the Russell 2000 that will be cool to share, but I'll let George contribute anything here.
Yeah, I think that's what I find the most compelling thing about our website, our app. The first thing I do when I go to our app, we have 2 pages on our app. One shows the actual chart and trend line and a bunch of statistics and a bunch of information about a specific equity or symbol. And the second page over shows you a list of essentially all the sectors and all the major indices, all the major, S&P 500, small caps, large caps, the QQQ or the Nasdaq. I think that's what's the most compelling thing about our site, is that on one page you can see what the FVE states is a good value or is a bad value relative to other assets, if that's how you choose to interpret the data, I guess I could say.
And not only that, we have these things called spread models on another tab, which I go to almost every day just to see how particular parts of the market are performing relative to other parts. So for instance, we have a spread model that measures relative valuations between small cap and large caps to see like, what is the better deal? Where should I allocate? Should I put more into large caps, more into small caps? Does it matter? Maybe they're neutral to large caps. And so the spread just blew out. And then people realize, oh my gosh, interest rates are getting cut. This is going to help small companies. And then small companies absolutely shot up like a rocket for the next like 9 months. And they peaked around 2021, like early to mid 2021, just about the time inflation was starting to creep into the market news cycle. And inflation, rising interest rates, bad for small caps, because small caps have to roll their debt more. They have smaller cash balances. There's just numerous reasons why small caps are going to get hammered during a rising interest rate environment. Sure enough, small caps peaked in, March-ish of 2021, almost 9 months before large caps peaked in January of 2022, because they were at the leading edge of the inflation concern. And then they just got absolutely hammered over the next, really until like the next 2 years. And then in late October of 2023, that spread blew out again, and large caps were super overvalued relative to small caps. And again, just on early July, right before this big move the last few days, small caps were registering their cheapest relative valuation relative to large caps, only second to that 1 week in April 2020. So we're talking about a 1 in 520 situation. If there's 520 weeks in 10 years, we're like, way less than 1%. So, the slingshot had been pulled back, so to speak, and all there needed was just a little catalyst for small caps to just absolutely rocket ship. And sure enough, there was, better than expected CPI, and boom, it just that means potential rate cuts from the Fed, and it just absolutely lit a fire under the small caps, and they're up 11.5% in the last 5 days.
Essentially, a lot of times whenever you watch CNBC and Bloomberg, less so. CNBC is more of like a pundit station. It's more sensationalized. You'll hear the pundits. I don't know if you'd call the hosts on there pundits. You
the pundits.
You would call them pundits if they're not political pundits.
I think
are they still
pundits? I think a lot of them are pundits that want to be pundits.
Yeah. Well, you hear them talk about like the difference between small and large caps. You hear them are small caps of value, or large caps of are large caps at a value, right now? Like, what's a better investment? And they're just talking. It means nothing. Right. When people just say just words, they're just talking to hear themselves talk. On our website, and I want to point out that it's quite significant. On our spread model, on Truby's spread model, it's the spread between large and small caps was over 17% of what it should be. It was small caps were significantly undervalued compared
Yeah, we're
to
talking almost three, I think it was around 3 standard deviations um, away from the long-term average, which is around 0. I mean, it's crazy, just ridiculously spread. And that's partly because of the AI-driven rally in large caps and the longer for later interest rates situation where interest rates have been really high for quite a long time. So yeah, things were poised really in a big way for small caps to rally with minimal catalyst. And yeah, it was just, I actually did a tweet on July 5th, so right before, and I said, what is happening? I didn't even need to change the default on Twitter, X. It just, that's the default tweet. What is happening? That's all I need to say. What is happening? Small caps are so cheap right now relative to large caps because I was looking at the spread model. I didn't know that, a few days later, there would be an 11.5% rally in small caps, but I knew it was coming. I knew some sort of rally was coming because that situation is so uncommon. And so the cool thing about what George was saying is that you can make your decisions based on data, not based on what your neighbor said or what your friend said or what the pundit on CNBC said. That's all fine to listen to, and sometimes it can provide you useful information to create a broader picture about your decision making. And I'm all for bringing in tons of information into your decision, but our tool just gives you a price-based, data-driven decision, which is based on 20 years, thousands of weeks of data, number crunching. So we feel confident that we just let the numbers speak for themselves, and then we can feel confident to use that as an important part of our decision making. I have some other stats about this Russell 2000 move, but did you have anything you wanted to add?
I would just add we Truby pointed out the FVEr Twitter account, which Truby made the post, to be fair, pointed out 2 weeks ago that the spread was so large. And then this incredible rally happened, which there's some luck involved in that. There's a little bit of luck. There could have been
For sure.
a sustained deviation from the from the center line, I suppose, from what a normal spread would look like. But statistically, that is an anomaly. And statistically speaking, at some point,
it'll come back.
The spread is going to, the spread is going to
Yeah.
consolidate back towards the center. And it just so happens that the very next week, it went from a 17% spread to a 12% spread. And our model updates on Friday. On Friday, I would bet you, maybe you already have the background data on it. I bet you it's going to be close to a, what do you think, an 8% spread or a 7% spread?
It's already down to like 11 or 12.
Yeah.
I haven't checked in the last day or so. It might be down to like 9 or 10, but it's just dropped like a rock.
Yeah.
And yes, I think we both want to point out that our model doesn't tell you tomorrow when something's going to happen, but our model has been giving you plenty of time to make allocation decisions if that's what you so choose to do. We don't give particular buy or sell signals. We just say what we do and what our model is saying. But like personally, from my experience, I have been increasing my allocation to small caps over the last year because I didn't know when it was going to happen, but I knew it was going to happen because small caps have been just consistently the cheapest part of the market, and they're a broad market index, and they're going to rally. And so I didn't know it was going to happen the last 5 days. And to be fair, it's up 38% since late October. So it's not like the entire rally has happened in the last 5 days. Small caps have just done actually quite well. And, it is funny to watch CNBC or look at their website or go to Yahoo Finance. And all of a sudden, small caps are the rage. Every article, small caps are, doing so great. They have so much upside, like they are amazing. And, a year ago, the entire narrative was switched. Stay out of small caps. blah, 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 they're doing poorly, blah, blah, blah. And so our model can sort of sniff that out before people realize that it's a good investment. We're like, the data will sniff it out before people get in. So you can get in, you can make decisions based on the data, and I think 38% return since late October 2023 is an incredible return for any index. And now it's outperforming the large caps. So yeah, just a couple of points to add on to that. So today is July 16th, the day we're recording the podcast. And the Russell 2000, which is the small cap index, it closed 4.4 standard deviations above its 50-day moving average. Crazy amount. No other major US index, and the indices are Dow since 1900, S&P 500 since 1928, Nasdaq since 1971, have closed at that much of an extreme. So basically today, the Russell 2000 hit a new record of closing 4.4 standard deviations above its 50-day moving average. And a moving average is like averaging the price of the index over the last 50 days. So this is incredible. Like, it's been a massive move. It's up 11.5% in 5 days. And again, yeah.
11.5% in 5 days it's magnificent seven level moves, like earnings reports moves, and it's an entire index that's experiencing a rally. And to be fair, you and I have been allocating little bits to the Russell 2000 over the last year, and it did take a while, or year and a half.
Oh, yeah.
And it did take a while for this to pay off.
Absolutely. And again, our model does not tell you when it's going to happen. It does not think that something's going to happen tomorrow or next week or even next month. You really need to be patient with it and give it a 12 to 18, even 18-month horizon. So to really let the model run its course and let things come back to fair value. Just adding on to the small cap discussion, if we move one class up to mid caps, they've had an incredible run as well. Mid caps for a while really were outperforming small caps. And I was allocating to mid caps as well throughout the last year. And one of the big delays for small and mid cap rally, the reason why it took so long, is we had this bank crisis in March of 2023, which threw a complete monkey wrench in the small mid cap rally, because financials, regional banks make up such a large constituency for small and mid cap indices. And regional banks got absolutely hammered during the banking crisis when SVB and a couple other banks went bankrupt, and it was a huge crisis, and small and mid cap indices just got hammered. And so basically that really was a black swan event, which threw a complete monkey wrench into the small mid cap rally. So it really sort of delayed it by about 6 months. I think without that, both the small and mid caps would be even higher than they are today. And like, our model does not know when black swan events are happening, right? So like, we don't know, but eventually the market will normalize and go back into a normal paradigm. And so it got back into a normal paradigm, and then it took really another year, and now we're really rolling in that area. So I think that was one of the reasons why there was a delay. What do you think on that?
I think that's a good thesis. I think I hadn't considered the regional bank rush. I mean, there was only 2 failures, Silicon Valley Bank, and what was the other one? There was another semi-major regional bank that got bailed out or failed or something. I can't remember. Do you remember?
Yeah, I can't remember the name. I know that PacWest almost failed, but they got bought out by JP Morgan. Another bank actually went under. I can't remember the name. Across the board, though, regional banks got hammered, and that in turn hammered small and mid cap indices for a while.
Yeah.
Also, economy has been really rolling, and inflation has been stickier than thought. So it's taken a while for there to be clarity around interest rate cuts, and that led to a further delay in small and mid cap rallying. But again, like, our model doesn't see that. It's blind to news cycles. It's blind to black swan events. So again, we totally encourage you to use all the information at your disposal, including our model, to make good decisions for you. We're just one other tool in your toolbox, but we do think it's a super powerful tool.
To a certain extent, I think maybe the market sees the Fed cutting rates, or maybe the market has accepted that rates are going to be high for the next, not that rates are historically high, because they're really not. The Fed has been raising rates. Well, they've stopped raising rates, but the Fed raised rates, and I personally do see rates remaining at this level for the foreseeable future. And I think maybe the market, after good data, Fed not giving any indication that they're planning on cutting rates, has accepted the fact that rates are going to be at this level for a while, which finally has given rise to small and mid caps to a certain extent. Maybe that could be a theory behind it,
I think it's that there's clarity that rates aren't probably going to go higher, and small caps don't want high interest rates, and mid caps don't want high interest rates. They want rates to come down. So there's clarity that rates are not going to go up anymore, and there's beginning to be some theory that rates might actually be cut in September, and that's really what has stimulated this 11.5% run. I'm sort of in alignment with George. In general, I think I am in alignment with George, which I'm skeptical of a rate cut in September because, the market is doing so well. And if there's hesitancy or further clarity that there won't be a rate cut, then there might be a quick pullback in the small caps because they're very fickle when it comes to these rate cuts. And so there might be a lot of optimism baked into this 5-day rally. And so we'll see what happens. Certainly when something goes up a lot really quickly, it usually will come down a bit, like a short-term bubble. But I still think, broadly speaking, small and mid caps are the cheapest parts of the market. We could broaden out the conversation to the market in general if you want at this juncture. It seems like a good segue.
Yeah. Do you want to broaden it out to everything is overvalued right now, or do you want to broaden it out to sector-based talk? Because let's broaden it out to there's nothing that's a deal anymore to a certain extent.
Yeah,
there's I think no deals.
I'll talk about the broad market and you could speak to some of the sector stuff that you're seeing.
Yeah.
So yeah, we cover 18 broad market ETFs, from the QQQ, which is the Nasdaq 100, to the small cap 600 value, to the Russell 1000, to the S&P 500, to an ETF which tracks the Dow Jones. We only do US-based ETFs at the moment. We may introduce some coverage of international ETFs, but it's yet to be determined. We have to do more examination of those parts of the international market and if our algorithm is appropriate for that. But getting back on course, so we have these 18 broad market US ETFs. As of close today, which is July 16th, that's the day we're recording this, every single ETF that we're covering is above its FVE. Again, the FVE is fair value estimator. The S&P 500 is in 1-star range, meaning extremely overvalued. Small caps are neutral to even now moderately overvalued given their incredible run. I think the Russell 2000 might even be close to 4% above its FVE last time I checked. There is, from what our model is saying, there's no cheap parts to this market. Like, you name the part of the market, it's overvalued, either neutral to moderate to extremely overvalued. The S&P is about 11-ish% above its fair value estimator. Just for reference, it peaked out about 18 to 20% over its FVE back in late 2021, right before its peak. So, it can be higher, but it's extremely rare for it to be in this 1-star territory. It's only about maybe 10% of the time over the last 10 years that it's been in this 1-star territory. And all of that time, other than now, was during 2021, when interest rates were near zero and there was incredible amount of speculation. Interest rates are 5% right now. and may come down by, like a 0.5% by the end of the year, maybe a little bit more. I don't see a backdrop for high levels of continued speculation. So I see a 5 to 10% pullback through the end of the year.
I'd 100% agree with that thesis. Like Truby said earlier, our model's not going to tell you when these events are going to happen. We can't tell you in 3 months there's going to be a pullback, in 6 months there's going to be a pullback. But based on the data that we see from our model, it would indicate that at some point there is going to be a pullback, statistically speaking, because everything is
like within the next 6 to 12-ish months. Probably. We don't know when it's going to happen. These bull markets are incredibly addictive for investors, and people like to keep piling in. So they usually overshoot. And then there's a scary trigger or catalyst, and boom, it falls like an elevator, very quickly.
It'll probably be, if I were to guess, which there's no guessing, who knows what it's going to be. But if I were to guess, it's going to be something AI related. It's going to be a bad NVIDIA quarter, a bad Google quarter. It's going to be something to do with AI that's going to trigger a major pullback in the AI stocks or the Magnificent Seven stocks that would cause it. We don't know when that is going to happen. And also, that being said, it's not very, and this is my opinion, it's not a very smart idea to bet against a bull market. Now, I'm younger, and Truby can give his perspective on it as well. I'm younger, so I'm pretty much fully allocated to the market right now. I'm holding maybe 3% cash in total right now because, and I'll show this, I'll put this up on screen right now. Fidelity released a document that shows what if you missed, the best and worst days in the market. Yeah, it's assuming you're invested in an S&P 500 index fund. If you're invested all those days with an initial investment of $10,000, you will net $1 million, or not net, you'll have $1 million at the end of the period.
990.
Yeah, whatever it is. And then if you miss the 5 best days, that number goes from $1 million to $700,000 by missing the 5 best days. So
yeah, I think that's a really interesting stat, and it underscores basically the modus operandi or MO of FVEr, which is to be invested for the long haul and stay invested, and use our tool to optimize how you want to be invested at a given time and where you might want to allocate. And when things get super extreme, overvalued or undervalued, there's opportunity there. So yeah, I'm also generally always fully invested. I built up a little bit of cash recently because I feel like the market's high, but I'm also 37, closing in on 40, and George is a lot younger than me. So it makes sense for me to be a little bit more cautious than George, I think, from just a age perspective. But when I say a little bit more cash, I might mean like moving towards like 5, 6, or 7%. But I'm generally try to be fully invested. And I think that makes sense for a younger person. As you get much older, you really want to be more cautious for sure, because you want to protect that nest egg. So interesting stuff. We've covered broad market. It's looking expensive. What would a balanced market look like? Balanced market would look like some of the ETFs being undervalued, some of the ETFs being overvalued. It's like sort of straddling that 0% mark. That's not what we're seeing. We're seeing like every ETF that we cover, broad market, is overvalued. So I think both George and I can like confidently say we think the market's expensive. And, if you were waiting until now to invest because you think it's safe, you probably missed the boat on a lot of it. For the near term, if you have a 40-year outlook, continue your dollar cost averaging strategy. But trying to time in and out, is definitely super hard. If you're going to time in and out with like your whole portfolio, it's just going to be almost impossible to to time the market. What are your thoughts on that? Do you think we're closer to the top than the bottom, or who knows?
I mean, I would definitely say, without a doubt, we're closer to the top than we are the bottom. That being said, I mean, I think it's bad to bet against a market rally. I'm not going to change anything about, how I'm not going to change, my allocations majorly, mostly because everything is overvalued. So it doesn't feel like there's much opportunity to change allocations right now. It doesn't seem like anything is very cheap. I personally am not moving into cash because if this rally lasts for 6 more months and then the market drops, if the market gains, let's say, I don't know, over the next 6 months, it gains another 12%, the broad market, S&P 500, it gains another 12%. And then there's a pullback of 7%. If I'm not invested right now, I'm losing out on 5%. Now, that's just me saying numbers out loud. Those numbers mean nothing. Based on what I'm seeing here, I'm not going to be shocked tomorrow if the market drops 12% or, in between, say, 5 to 12%. And by the market, I mean the S&P 500 and I guess also just the market generally.
Yeah, I think it brings up an important point. George and I have been working together for a couple of years now, and we've done a lot of research on market history and looking at various different ideas and strategies. One of the things we found is that when you pull your money out of the market, even though it's really tempting to do so, you end up generally, if the market is going up and there's not like a massive bubble, you're going to end up putting your money back in at a higher low, right? So, and you'll have had to pay taxes on pulling the money out if it's not like an IRA. So for a young person, stay the course. One thing you can do, like what I do when I look at my portfolio, is I'm like, okay, I think the market's like 10% overvalued, and I'm just going to remove 10% from that number when I think about it in my head to get a better idea of what I actually think that account is worth. And there's no like action that I'm taking, but it just sort of keeps my expectations in check. If I have like $30,000, I'm like, well, probably it's actually really worth around $27,000. 30,000 is like pushing it right now. So it can sort of keep your expectations in check, and then it prevents you from like getting too greedy, or trying to think that being really upset when the market comes down, because you've already sort of baked in what you think a more fair value is.
And that's where our strategy, which I don't think we've ever released anything about publicly besides just teasing it on the podcast and TikTok and Instagram clips and whatnot. That's where our strategy comes into play, which is during times where the market is extremely undervalued, incorporating some form of leverage. This is my opinion right now. So this is not the opinion of FVEr. I would say generally it would be a bad idea to take any money out of the market because you don't know what's going to happen. I would say this would be a terrible time to be buying options or investing in 2x leveraged ETFs or incorporating any type of leverage in your portfolio. I think this would be an absolutely horrible time, which there's a little bit of a counterintuitive thing that happens in the market is when the market is going up, people incorporate more and more leverage and get more and more extended, and people on the internet talk about options and these get rich quick things, which is absolutely totally the opposite of what a person theoretically should be doing. Whenever the market is low, whenever the market is down, a lot of these finance gurus and these people that talk about the market on YouTube who are just talking out of their ass will disappear, and they'll be, they won't talk about anything. They won't be like talking about how you should be using options or leverage or whatever. Ironically, that's the time when you should be incorporating leverage. When the market is low, you want to incorporate leverage. when the market is high, you want to be deleveraging, which is maybe seems kind of paradoxical, not to me, because I understand functionally how that works, but I don't know. I would not be purposefully overextending yourself right now in terms of trying to eke out more gains in the market. The market is going up. Be happy about it. Let it ride. Don't buy a bunch of options. Don't use leverage. Don't use margin. Don't use options unless you really know what you're doing. I would say that's a terrible idea right now, given where the market's at, you know?
Yeah, no, I think that underscores the whole concept of our strategy, which is a bit counterintuitive to some people, and that is to opt into leverage ETFs at the index level. We don't do a strategy for individual stocks, but we're talking about leverage ETFs at the index level. Another way to leverage is using options, as George said. Moving into leverage ETFs when the market is moderate to extremely undervalued. And that's when you're going to get the most long-term bang for your buck. So I think, it's the old adage of buy low, buy low. Right now you're buying high. Again, we're not telling you to buy anything or buy any particular stock or index, but generally our models are saying that the market is extremely overvalued, and by market we're saying the broad S&P 500. So yeah, I think that's generally good comments there. What about at the sector level, George? What are you seeing there? I know when I looked, healthcare was looking to be one of the last bastions of a little bit of value.
Yeah.
And I would just say, like, what happens when you're near to a relative peak of the market? You're going to get defensive sectors, healthcare, consumer staples, and so forth are going to be lagging, undervalued. These are like blue chip Dow Jones names, old boring companies, Procter & Gamble, Coca-Cola. They're going to be sort of lagging. And the high flying growth names, the cyclical sectors, financials, tech, industrials, they're going to be sort of overvalued, expensive when you're getting sort of at the peak, near a relative peak of the stock market and economic cycle. And that's what we're seeing. So like all the indicators are there that we're closer to a relative top than a relative bottom. If we were closer to a relative bottom, we would probably see maybe more non-cyclical defensive sectors still maybe a little bit overvalued, and the cyclical ones maybe a little bit undervalued, and it would give more room to run. We're not seeing that.
Yeah.
I had one other thing to comment on, but I'll let you interject anything.
Yeah, so about 4 months ago, 3 months ago or so, specifically Excel, the utilities and consumer discretionary were pretty much the only two, and healthcare, but consumer discretionary and utilities more so than healthcare were the two sectors specifically in the S&P 500 that were kind of beat up the most. So, based off of our model, I bought some options. This was a pure bet. I want to just say this was a bet. I hadn't been tracking it for months. I just saw it on our model and I made the decision to buy the options. Those options, I sold them this week because I'll talk about that in a second. I sold them for two reasons. But those two sectors, when I bought them 4 months ago, are up about 12% each in the last 4 months. They've had essentially their rally in the last 4 months, so it was a good bet based off of our data. I noticed in my portfolio that I was really overexposed to options, so I wanted to just clear some stuff out. So that's the reason I sold those two. Eked out a huge gain on both of them. Also, in the last week, or the last 2 weeks ago, rather, July 1st, or essentially late June to early July, we started to see utilities dip back down, which I don't know. I found it interesting that specifically utilities and healthcare were rising, or that would indicate that maybe people are moving back more towards the defensive side. But in the last month, last couple of weeks, we've seen utilities start to dip back down, which to a certain extent, once again, indicates to me that people think this rally is going to continue. A couple of the sectors are behaving in ways that you wouldn't really expect. Like, for example, I would expect consumer discretionary to be quite a bit higher than it is right now. It could be low due to a variety of things. It is undervalued by 2%, which is relatively nothing, but it is slightly undervalued. That's relatively nothing. I think people might generally be moving away from consumables and maybe spending things more digitally. I don't know. Consumer discretionary should be higher, but there were a few opportunities, broadly speaking, in the specific sectors as of 4 months ago. Now everything is everything is up besides utilities, that would be expected. Utilities honestly probably should be lower than they are right now, but they are lower relative to the others. And consumer staples probably should also be a little bit lower than they are right now. If we see those rise rapidly, especially or relatively rapidly in the next 4 months, that would maybe indicate that people are perceiving, whether or not it's institutional or retail investors, perceive there being some type of slowdown. Also,
I think that's good analysis. I'm just looking here that healthcare has actually rallied back into 3-star.
yeah,
Really, since I last checked, utilities are the most undervalued at the moment, and then you've got consumer staples. So it's really utilities, consumer staples, healthcare are the most undervalued sectors, all defensive. This is exactly what you would really expect in a near the relative, nearer to a relative top than the bottom. If we get that any sort of significant rotation there, then it could portend a more significant, pullback. I think going back to consumer discretionary, this situation, we're basically have a secular AI driven rally in large caps, and it's overwhelming the inflation story. So basically the bull market is overcoming the headwind of inflation right now. And so that basically the AI story is driving the gains for at least a lot of it. Definitely the small caps, as I said, have had a good rally in the last 6 or 8 months, but a lot of it has also been from the large caps. So I think consumer discretionary being undervalued could be a reflection of the pressure that inflation is putting on consumers. And that could be one of the reasons. Also, some of the largest constituents of consumer discretionary, one of them is Tesla, and Tesla's had generally a rough year, first part of the year, and is finally starting to rally back. And so that's going to have an overweight effect on what that sector does because of it's like 10% weighting in that sector. Line, I agree, consumer discretionary should probably be higher, but I think there's macro themes why it's not. Namely,
let me look at what some of the holdings are in consumer discretionary and what is it? XLY?
It is the XLY.
Let's see. Amazon and Tesla are the number 1 and 2 holdings. I don't know. I mean, McDonald's is number 4. McDonald's has taken a beating. Let me double check that. MCD stock. I don't know what McDonald's symbol is. Stock price. I think McDonald's has taken quite a bit of a beating. Yeah, McDonald's is down 13% year to date. That's mostly inflationary. Food prices have gone up significantly.
Another member, Nike's been hammered. Nike's consumer discretionary, they've been hammered. Tesla's been hammered. A lot of it is China impact, right? Some companies have exposure to China. and there's recessionary type headwinds in China right now. So companies that have exposure to China, Tesla, Nike, they're suffering. So that could be another reason why consumer discretionary is having issues. Doing okay, but it's also riding the AI wave. So that is sort of overriding some of the underlying themes of why they might be having trouble in China. But yeah, some of the China consumer discretionary names could explain why that index is low. Last thing I just wanted to touch on before we wrap up, we're coming up on an hour or over an hour, is just growth value. We're currently, our spread model between growth value is showing that growth is starting to get expensive. It's not quite as bad as in 2020, 2021 era during, the COVID era when there was really low interest rates and growth stocks went into, skyrocket mode. But it's starting to look expensive. So if you're weighing where should I allocate, and you're going full growth right now, just realize you're buying into an expensive part of the market. Value is looking cheaper. It's not like an extreme amount cheaper. We're not like that small, large type of spread, but value is starting to look like a better, notably better deal right now. So continuing to have some value exposure and not going full high octane growth probably makes a lot of sense. Otherwise, what gets hammered during a downturn? Usually growth. So having some value exposure is going to offset. It's going to give you a barbell type of portfolio, which is going to really help if we have a significant rapid pullback.
But
So
everything's overvalued.
Yeah, everything's overvalued. That pretty much wraps it up from my end on what I'm seeing. George, do you have any final thoughts?
No, I mean, I think that's pretty much it. I mean, it feels like we covered a lot. Hopefully we have something to talk about next time because we talked about everything that we're seeing. I mean,
yeah,
the
there's always
takeaway.
new stuff. There's always things are always changing, and we keep an eye on our models every day, and then try to flag stuff that we think is important, and post it on our social media, write blog posts, do podcasts, and we hope that you find this useful for your own investing journey. Cool. We'll call it there.
Sounds good.